Good evening, everyone. Welcome to the Forex Masterclass. We're starting very soon, so could I just get everyone to take their seats? Thank you. Good evening, everyone. We're about to start in about 3 minutes, so please take your... welcome to our Forex Masterclass this evening. I'm your host, Olivia Higgins. Now today, it's about two important points. One, fundamentals, and two, strategy. 5 secrets to the high probability reversal strategy. Now before we begin, I would like to remind you that leverage trading is considered high risk. So use this seminar as an opportunity to learn, to network, and to be a part of a community of like-minded individuals like yourself. Now, with that, our speaker for today, he is the founder of the award-winning research firm Everest Fortune Group, and is also the Chief Analyst and domain expert of some of the largest financial institutions in the world. Let us put our hands together to welcome founder of Everest Fortune Group and the Forex Army, Desmond Leong, everyone.
Thank you, Olivia.
Hi, Desmond. It's nice to have you in person on a live show like this. How are you doing today?
I'm doing good. Right, I managed to squeeze in a bit of dinner. Is that okay?
That's good. Now tell the audience, for those who don't know you, a little bit about yourself.
Okay. So Olivia did a pretty good introduction. I started off in the world of trading, FX, about 8 years ago. 8 to 9 years ago, right? So I know I look kind of young, right? Right? Actually, mid-30s now, it's a good skincare routine kind of stuff, right? But I've been in this area for quite a bit of time, right? I previously worked at a brokerage, right? I worked at a brokerage, FX brokerage, right? And that was there where I realized that it is true that, FX is not an easy game to trade, right? So from there, I actually went into the institutional research space, right? So it was this company, right? We were advising the largest hedge funds and banks, right? And I kind of learned a lot of what I'm going to share with you today, right? From them, right? So it's I've always been kind of chasing, a particular strategy, a particular kind of indicator, right? But from there, when understanding how the institutions do it, right? So it really opened my insights, opened my perspective, right? Which I hope to share with you guys today.
So Desmond, could you tell us a little bit more about the term high probability reversal strategy?
All right, yeah, it's a good question, right? So why I like to include the term probability, right, is because it essentially is what trading is about, right? Investing is about. You don't afford, whether it's Apple shares, whether it's euro dollar, whether it's gold, whether it's oil. Before you take a position, right, it's always about what are the chances, what's the probability of this going in my favor, whether it's going up, buying or selling, it's going down. It's all a case of probability, right? So it's never a certain thing. Like if you knew for sure, like perhaps if you time travel back and you knew for sure that Bitcoin's going to recently or maybe previously, how high Bitcoin can rally until, and you have 100% certainty because you're a time traveler. What are you gonna do, right? You're gonna sell your house, you're gonna do everything. Not that you should do it here, right? Not financial advice, right? Yeah, you would go in very big on that because you have a full certain probability. Right? But we live in the now and then. No, we live in the here and now, right? And it's all, we don't have the 100% certainty. We don't have the 100% probability, right? So we're talking about here is to try to increase that probability as much as possible, right? So that's the first part of it. The second part of it is reversal, right? There are two kinds of trades, right? There are the breakout trades. Like you see a key level, price reaches the level, and two things can happen. It can bounce, or it can break through, right? So there are essentially in the world of trading, there's almost like it narrows down to these two, right? Today's session is going to focus more on the reversal. People call it the contrarian strategy, but yes, the reversal, usually if you know how to execute the reversal right, you tend to get a pretty good risk reward. Right, but today's session, yes, less about breakouts. It's going to be more about like how are you going to call that reversal, right, in a high probability manner.
I'm excited to learn more about it. Now, Desmond, today we don't just have the audience here today. We've extended it to our live audience watching right now In-app, welcome everyone to the live show. Those of you who are tuning in right now, we are live from OUE Canvas in Singapore. And thank you so much for joining in, both people in person and those online. Now, this is the time I would like to encourage you to ask your questions, because we're here today for a two-way conversation, right, Desmond?
That's right.
We're here to be a part of this community that we're building, and we want to be together to guide each other through our financial journey.
That's right.
Anything to add to that?
Yeah, so one thing I'd like to let you guys, whether it's in-app over here, right, if you encounter any moment where something's not that clear, right, feel free to ask it right away, right? We have a little bit of time in between to ask questions, because the last thing we want is there's a particular term that you didn't quite understand, and then I keep using that term until the end of the seminar, and then you keep wondering what's he referring to, right? So yeah, do not hesitate to pause me, right? Or rather, ask that question, right? Especially the guys who are here, right? You have kind of first priority versus the I think thousands of people in app, who need to vote to see who gets to the top, right? So if you can just ask, right? I'll be sure Olivia will help in ensuring that I answer the questions, right? But yeah, don't hesitate whether you're in app or here, right? Just ask me those questions.
Yes, I will pick the best questions to ask you at the end. So people in the audience, I know some people already want to ask you some questions, so we'll save that till the end of the session. In today's masterclass, it's about 5 essential components. You'll learn about establishing support and resistance zones. What is momentum? We're talking about the introduction as well to the Fibonacci. What is the confluence element? And trade management. So how can you effectively manage trades? And then we'll go into the questions with the community. So with that, I would like to hand the floor over to you. The floor is yours, Desmond. Enjoy the masterclass.
Okay, thank you, Olivia. Okay, so let's begin today's session, right? Let me see if this works. Okay, cool. Right, disclaimer as usual, guys. I know Olivia covered previously. Everything in this session is educational, right? So nothing should be construed as investment or trading advice. So please do your own due diligence. Longer disclaimer here if you don't read, right? But I won't go through it. All right, you get the gist of it. Okay. Now, I do a quick introduction to myself. Right, this is the agenda for today. Quick introduction to myself. I'll be touching a Forex 101 really briefly, right? Because I understand from most of the audience here very familiar with trading shares. Right, very familiar with buying and selling shares, but when it comes to Forex, there's just an additional element to it where it can be a little bit, you kind of wonder, what does it mean to buy euro dollar, right? What's a base currency, what's a quote currency? I'll just be touching on that a little bit, right? But I do want to let you guys know that what you're learning here today, right, especially the technical analysis part, right, is universally applicable, right, to different asset classes, whether it's shares, whether it's commodities, whether it's crypto, whether it's FX, right? So it's universally applicable, okay? Just that different asset classes tend to behave a little bit differently, okay? Now, a little bit about myself. I look much younger, right? Yeah, so Olivia introduced me already. We are the 2019, 2020, 2021 Best FX and Best Equity Research finalists. Right, so we know very well what happens on the FX side and sometimes the nuances when you apply it to the equity side. Okay, now I'll skip this because Olivia did a really good introduction. Right, I'll touch a little bit on Forex 101. Okay, for those of you who are here and know about Forex already, bear with me. Right, I think it's important for us. I just need to explain a few terms for you guys. Right, most of us will be familiar with arcade. The arcade money changers. Right. Recently, you've been traveling. We need to exchange currency. So at its core, Forex is foreign exchange. In some sense, it's just the exchanging of money. Okay. In some sense, it's just the exchanging of money. So we are actually more familiar with it than we might be led to believe. Right. We've all changed money. Maybe you want to travel to Malaysia or travel to Australia. We've all in some sense changed money, right? We've went to the money changer, right? We've looked at the different rates, right? That is actually called the bid and ask spread. right? So the bid and ask. You look at the different rates, you walk around, right? Walk around and you see, oh, which money changer has the best rates, right? And with the best rates, then you will go and buy that currency, all right? Or if you're coming back from holiday, you have, maybe some Australian dollars. You want to look for the broker, right? If you treat each of these money changers like a broker, right? You want to look for the one who will give you the best, the most money for the Australian dollars that you have. So that, in its essence, right, it is really at the core is what Forex is about. It's the exchanging of money. Okay? Now, so let me see the next slide here. Okay? We touched on this right before I touch on one more point. Okay? So when it comes to shares, it's very simple. I wouldn't say it's very simple, but when you are thinking of buying Apple shares, you want to know, it's very, very relatable. Correct? You're thinking, okay, would Apple do well? If it does well, price will go up. If it doesn't do well, price will go down. Right? We see it that way. But when it comes to Forex, and we're saying, okay, I'm going to buy euro dollar. Okay, what does it mean? There is euro, EUR, and then there's the other part, there's a slash in between, and then there's dollar, USD. So you're thinking, do I just buy euro dollar because I expect euro to strengthen? Right? Then what does the second part have to do? Why is there a slash USD? Right? There's slash USD, there's euro Aussie like slash AUD, there's yen slash JPY. What does it mean, when there are these two parts of currency? Okay? Now, the important thing to take note of here is that when you're buying euro dollar, right, you have two currencies, right? You have euro and dollar. You want one to go up, and you want the other one to go down. Okay? I mean, a bit off the cuff here, but I got an example, right? You can try to think about it in the form of a division. Okay? So for example, if we have, I'm gonna put this down here, right? If we have like, we did division before. 2 divided by 2, equals 1, right? 2 divided by 2 equals to 1. Okay? Let's just treat the numerator 2 as euro. And let's just treat the denominator USD as 2. So equals to 2 divided by 2 equals to 1. Okay? If euro strengthened, 2 went to 3. Okay? But at the same time, the USD also strengthened. So the numerator went to 3, the denominator from 2, it also went to 3. What is the final value? It's 1. Right? So even though euro strengthened, right, because you were trading euro dollar, you need to measure the strength of USD. How much did euro strengthen against the dollar? Right? So it's not only, in this case, euro strengthened to 3, but USD also kept up. It also strengthened to 3, and so your final value, if you're buying euro dollar, right, it'll still be 1. You didn't make any money. Now, the other side, right, if euro strengthened, right, 2 went to 3, and let's just say USD stayed the same, right? So the denominator is 2, right? So you got 3 on top, you got 2 below, right? Now the final value is 1.5. So technically, if you were, you load your Moomware, right, and you were buying euro dollar, and it went up from 1 to 1.5, that means you would have made money. Okay? So it's always about 2 different currencies, right? One is euro, like in this case euro, versus another currency. And the best case, right, especially for many of us doing technical or fundamental analysis, is to find the strongest and you pit it against the weakest. Because imagine, right, if euro strengthened to 3 and USD at the bottom, it dropped to 1. Now your final value is 3, right? So it went from 1 to 3, right? So if you bought euro dollar, wow, you made more money, right? So it's not always a case of, oh, euro dollar is very popular, right? I will just go trade euro dollar, right? You must think about, okay, you think about it today, what is the strongest currency? And let's just say that we know that USD has been strengthening, right? So then we think, okay, what would be the weakest currency? Then I want to pit them two together. Okay, you don't pit one strong currency against another strong currency, right? Then they might they're like boxing. It's like both are heavyweights. It's a very fair fight. You want to pit a big guy versus a small guy, right? That gives you the best chance of winning, right? They say, okay, I bet that this big guy will win, right? Because you're betting strong versus weak, right? At its core, that's what Forex is about, right? You want to find a strong currency, you want to put it against a weak currency. Now, when it comes to trading then, shares. Shares, when you are thinking about should I buy Tesla, should I buy Apple, okay, what do you look at, right? You kind of look at what's the new iPhone going to be, right? I think it's iPhone 15, 16, 15, 15. Yeah, so for some of you know, right? It's an iPhone 15, right? Then you kind of, you do your research, you go and you search up the news, like, okay, what is the new thing about iPhone? How good is it, right? People dive more into the financials, right? What was the revenue of Apple? What's the profits that they made, right? So what you're doing is you're essentially measuring the health of a company. And then you decide, all right, should I buy it or should I not buy it, right? So that is what shares is about. Forex is the same thing, just that you need to do it for two different currencies, okay? For example, if the revenue and the profit, the P&L, right, were the, it's like you go to a doctor, they measure your blood pressure, cholesterol level, stuff like that, right? But for companies like Apple, Tesla, right, they measure what's your revenue, what's your profit, what's your cost, what's your loss, right? So it measures in that sense. For countries, they look at GDP. How well were you doing? What is your inflation? Right? Sure, you're making money, but how high is inflation? What are your unemployment numbers? Right? You look like you've got a very good, country running, but if unemployment is through the roof, right? So it's like you're measuring the health of someone, right? So that's what. So it's not that far-fetched. You think about it. On what Forex is from trading shares, right? You're still monitoring the healthiness of a country, the same way you measure the healthiness of a share. The only difference is that you want to find the strongest, fittest person, right? And you want to pit it against the weakest. Alright, so you want to find the country that is doing the best, and you find that the country that is doing the worst, and you pit them together. Right? Then you know whether to buy or sell. Okay? Right, so yeah, at its core, that is really what Forex is about. Alright, so for those of you who are new to trading Forex, it's not that far from shares. Right? Just that sometimes I would say it's a little bit more fun because you're not just trading like one, you're not just trading the strength of the US economy. You're trading the strength of the US economy and you pit it against another country. Right? And that really sometimes you can see big movements in Forex. Okay? Now, really simple example here. Let's just say we're going on holiday to Japan, the land of really good sushi, right? So I have 10 USD. Okay, for the sake of this example, I have 10 USD, right? I'm gonna change 10 USD, right? I'm gonna change it to 1,000 yen. I know that doesn't sound like a lot, right? Because it ain't a lot, right? So I now have 1,000 yen. I go to Japan, right? So after I change my money, I fly to Japan, and I realize that wow, maybe I should have changed more than 10 USD, right? Because I have too little money to spend now, okay? And then, so after the entire trip, I fly back to Singapore, okay? And I now have the same 1,000 yen, okay? The exchange rate changed from 1 USD to 100 yen to become 1 USD to 110 yen, okay? The question I have here is, did I make or do I lose money? Okay, a little bit of participation, so I know how well my analogy earlier worked out. Okay, if you think that we made money, all right, can you guys raise your hands? Right. So I'm assuming everyone is the other answer lah, right? Then I lose money lah, right? Okay, I didn't. Okay, in that case, everyone's correct, right? Then I gave a really good example, right? Okay, I just hope lah. Okay. So yeah, we lost money. But suddenly, with 1,000 yen, right, I cannot get back the 10 USD. I probably get back only 9 point something USD, right? So you can see, how it actually affected it, right? We just same thing, right? Same 1,000 yen, but depending on the exchange rate, whether you were on the side of the USD or the side of the yen, you end up making and losing money. Okay, so it's very real. If any of you guys who are holding currencies and you realize that, wow, I thought I should have changed my USD last time, now I hold for so long, now, worth so much less, right? That is what Forex is about. That's a long-term trade in Forex. Okay? Now I do want to touch on the last two points on, I think it's leverage and risk reward. Okay? Right? This is universally applicable to trading shares too. Okay? Here, I got two accounts. Okay? One account has a leverage of 1:10. One account has a leverage of 1:50. Okay? They are taking a trade. They are looking to sell 100 units, right? 100 units. They're looking to sell, expecting prices to drop all the way. Okay, that means if it drops, it makes money. I have two accounts. Okay, one account, 1:10 leverage. Another account, 1:50 leverage. Which account will make more money? Anyone want to take a guess? Please. What 1:50? Any other different answers? Right? Anyone says it's 1:50, maybe you can give me a quick raise of hand. I mean, you say just on raise a bit, that's all. Right? Okay. Anyone says 1:10? 1:10. 1:10. Okay, here and there. The answer, right, is that you make the same amount of money. Okay? So there's a lot of talk out there, right? Different brokers, that you should go for higher leverage because it means that you make more money, right? And a lot of people think that a trade like this, because you got higher leverage, you end up making more money. It's entirely not true. You'll make the exact same amount of money, right? It's still 100 units. It's still dropping this much. It still hits there. You make the same amount of money. The only difference is that with 1:50 leverage, you can technically open 5 times the number of positions as 1:10, right? That doesn't mean that you open 5 times the number of positions, you're going to make more money, right? Because it's like that Spider-Man quote, with more power comes more more responsibility. The same thing with leverage. With more leverage, it comes more. I found a way to connect it last time. Before I came out. It's more leverage comes more trading, power, right? Essentially, right? So you can make more, you can lose more. Okay, you can make more, you can lose more. Okay, that's what leverage essentially does for you. You can open bigger positions. You can open technically 5 times more than the other one, but that doesn't mean that you can make 5 times more. You can end up losing 5 times more. Okay, right? But if you open the same units, right, later shown in Momo app, you will make the exact same amount of money, no matter whether if someone has a 1:1,000,000 leverage. Okay, now 2 strategies. Okay, so we touched a little bit on leverage here. Okay, now 2 strategies. Right, strategy A, we have a 50 pip stop loss over here, so 50 units of stop loss, and we have a 90 units take profit at the bottom. Okay, strategy A. Strategy B, we expect prices to go down by 36 pips, and we have a 20 pip stop loss. Okay, you put them side by side. Strategy A, 50, 90, strategy B, 20, 36. Which one is gonna make more money? Strategy A or strategy B? Anyone want to take a guess? For prices? Anyone say strategy A? Strategy A, strategy A. Okay, a couple of strategy A. Strategy B? Okay, you cannot answer both, right? Change your answer. Okay, I like that. What's your answer? Both are the same. Sorry, what's the name? What's the name? Clement. Alright, Clement get a really good answer. They are both the same. Many people think that strategy A will make more money. Right? They see it on those Telegram groups, they see it online, someone says, oh, I made 100 pips on the trade. And they think that, wow, that's great, 100 pips means it's a lot of money. Right? Pips is what we use to measure in the world of Forex. Alright? But it's exactly the same, because what you need to do is need to divide, right? Okay, maybe not over here, right? You take 90 divided by 50, the answer is 1.8. You take 36 divided by 20, the answer is 1.8. Your risk to reward is 1.8 for both of them. If you risk $1, you're gonna get $1.80. Okay? So a lot of people tend to look for profit, right? They just see how much pips you're going to make. The important thing to take note of is that you need to look at profits and you also need to look at loss. How much were you willing to risk to chase that profit? Okay? And that is why, now, when I talk about high probability reversal, so this is the one of the last slides before I go to the secrets, alright? Why do I place such a big importance on calling a reversal, a high probability reversal? Is because you can keep your stop loss very tight. Imagine this, okay? Technically, 36 divided by 20, right? That is 1.8. If I was able to tighten my stop loss, right, it would be 36 divided by 10. What is my risk reward now? It's 3.6, right? So I risk $10, I get $36. If I was able to tighten it even further, right, to 5 pip stop loss, right, I now have a 7.2 risk reward. That means if I get one trade right, I can get the next 7 trades wrong, and I will still be, I'll still be in profit. So it's not only the profits that we're chasing, right? So a lot of these strategies out there, you read on maybe Pips, you read on like those forums, right? They always talk about how much profits you can go for, can make, right? But they never ever see the other super duper important side, which is the stop loss, right? How much of your account are you willing to risk in pursuit of that? Okay, the tighter your stop loss can be, the higher probability your reversals can be, the better your risk reward can be. Okay? Now, let me see. Yep, so it's not about the number of pips you make, it's about the risk to reward. Okay? Now, I've caught the first part here, right? I want to see if anyone has any questions, let us online or offline here.
Any questions from the audience here so far? About the terms that Desmond used? No? Okay, well, Desmond, I've got a question from online. Okay, so are you saying that Forex is not due to the interest rate differential between each country? And where are the parameters that will affect the interest rate causing the increase and decrease?
Well,
perhaps the latter question is something technical you'd like to address first.
Well, I mean, I guess the question kind of sounds like, yes, it's a very technical question, which we can cover more later. But yes, interest rate differentials, right? Like if a country increases the interest rate, there's more money going in, the currency is strengthened, this and that, right? Technically, yes, but there are a lot more things that affect it too, right? Like it's not only the interest rates of the country that will affect, whether it's going to strengthen or weaken, right? It depends also on how well the economy is doing. Yeah, so it's many different factors, not only fundamentally, but if in this session technically, right, relying very heavily on technical analysis, right, that also affect where price, at least in the short term, medium term, where prices can head to for the Forex market.
Thank you. Any more questions?
Okay.
Can you tell us about the first secret that you'd like to share?
Okay, so I covered this part earlier with you guys, right? Breakouts and reversals. Okay. Remember, we are trading reversals today, a contrarian strategy, right? Not breakouts. Okay. Now, the first thing I'll talk about is supply and resistance. There's support and resistance zones. Okay. Support and resistance zones. Okay. This is something which you need to train your eye. I believe you'll be having further sessions in the future where we actually teach you a little bit more on how to identify support and resistance zones. Okay, one of the key things I want to highlight to you, one of my favorite ones, right? Because it's going to be tough to cover the entire session today on just supply and demand, right? Support and resistance, right? The first one is you want to look for what I call the overlap. Okay, the overlap support overlap resistance. This is a level. Right? I know it's a little bit hard when looking at this, like why did Desmond draw this level over here? Okay? Usually I would have a mouse and it's a lot easier for me to draw. I'm going to use the laser pointer and try to explain it to you guys. Okay? What you want to look for is for a level where price respected it one time minimally at the top and one time minimally at the bottom. Okay? You can see here, price bounce off one time over here, price bounce off one time over here. Right? So minimally, it has already bounced off it. You're looking for a clean break. You're looking for a very clean break. It goes down to here. Then you're waiting for price to come up to test it again. Okay? This is called the overlap. Okay? There are many different ways to draw support and resistance, but this is one of the ways that, different people have different terminologies for it. There is you can call it the pullback, right? You can call it probably just a pullback, I think about these. Right, yeah, it's a pullback, overlap, right? This is a big level here. Now, this by itself is not enough to trade, okay? It's not enough to trade. It might give you a certain probability of being correct. Okay, I see this with very carefully chosen words. Okay, this might give you a 30% chance of being right, meaning that if you use support and resistance alone, and you keep using this and say, learn this and say, oh, Desmond, tell me, go look for overlap. You read up all about it, you go back, keep using it, you might end up still losing more money, right? It still be an unprofitable strategy, okay? But how do you improve the probability of this setup? Okay? Now, the world of trading is very different from the world of academia. Hope I pronounced it right. Academia, alright? So we've all grown up in schools, right? All grown up in schools, we know that the harder we study, the better we do. The more time we spend studying for the exam, naturally, you're going to do better. Unless you're reading the wrong textbook, right? Then you're not going to do very well. But otherwise, there's a positive correlation between how much you're studying, right, and the grades you get. But that is very dangerous in the world of trading because it's not always the case. You can spend a lot of time studying the wrong strategy. Or rather, you can spend a lot of time studying the wrong approach. Someone might say that to use the stochastic or to use moving average, you must always use the 100, you must always use 80-20. You spend your time learning that and you realize that, you might be wrong, right? I have a different style of using stochastic. Maybe you'll cover that in future sessions, right? But you can actually spend all your time learning the wrong stuff, right? I'm sure many of us out there, we have seen so many trading gurus out there. Each one has their own different approach to trading, right? Judge your arm and a leg, teach you about some moving average and stuff, right? But you end up, each one has a different interpretation. So you might spend money learning the wrong stuff. So it's not like there's a governing body in education, right? It's that this is a textbook that you need to read if you're learning math. Everything, is logical, right? In trading, you might end up learning the wrong stuff. And another equally dangerous thing is that you might end up applying it wrongly, even if you learn it correctly. What do I mean by this? An example, right? So I've seen a lot of people who like to have an over-reliance on oscillators, okay? They throw on the stochastic oscillator, they throw on the RSI, they throw on the MACD, right? And all of it says that price is overbought, and like, all right, I got 3 confirmations that price is overbought, it should be going down. But the danger with that is that you are actually just looking at the same story told 3 times, right? It's all from, it's like you go to a showroom, right? Maybe you go to a Mercedes showroom, and you ask someone there, what's the best car, right? They're not gonna say, yeah, our neighbors at Audi, they're not bad. They're all gonna say, yeah, it's Mercedes is really good. And you look at this salesperson, like, I'm gonna ask another person, you ask another colleague, and it's like, yeah, Mercedes is good, right? They're all telling you the same story, right? And that's the danger when you over-rely on a certain type of indicator, right? You rely too much on the oscillators, because they all only tell you if something is overbought and oversold, right? They have, partially overlapping similar calculations, right? But you're reading too much into one story where it's overbought, oversold. So if you apply all of that, you combine all the oscillators into trading, you might end up just losing money. You learn the right stuff, but you combine it the wrong way. You apply it the wrong way. So in trading, what I'm sharing with you today, if you notice what I'm going to cover later, is I'm going to cover, they're not all going to follow just support and resistance. I'm going to touch on momentum, I'm going to touch on Fibonacci, I'm going to touch on confluence, trade management, right? in more advanced sessions, we talk about correlation, right? One goes up, the other goes down. Like euro dollar goes up, dollar franc goes down, right? You can use correlation to really improve the probability of being correct. Too much to cover today, but I'll show you the next then, like why I'm combining these different things. Alright, so this could maybe give you, like I said, a 30% chance of being right. If you throw in a channel, right, momentum. Now, I'm a big fan of the term, the trend is your friend, you know, until it's the end, right? Then it's not your friend anymore, okay? So it's always better to trade in the direction of the trend, right? You just think about it. If you were swimming at sea, you can swim in the direction of the waves, you can swim against the waves, right? And if you're swimming against the waves, right, every time you're swimming, right, the waves are crashing with you, go a little bit forward, you go back, you go a little bit forward, you go back, right? And because you're swimming against the momentum. But if you were swimming, right, in the, along with the waves, you've seen people surfboard and stuff, you know, this is very easy, right? The wave will just carry you in that direction. So that is what they mean by the trend is your friend. Right? That means there is this overall bigger momentum trend that is pushing prices in your favor, whether it's down or up. Okay? So if you were looking for a reversal trade, in this example, you're looking for a sell order, right? You want to look for momentum. You want to look for momentum in a few different ways. One way would be channels. Okay? The rule of channels is very simple. 4 touches, 2 at the top, 2 at the bottom. Minimally 4 touches, right? So we got 1 touch, 2 touch, 3 touch, 3 touch at the top. We got 1 touch and 2 touch at the bottom. So we got 5 touches. The more touches there are to a channel, the better. You can have 4 touches at the top and 1 touch at the bottom. It's not a channel. Okay? You need minimally 2 and 2 to map out parallel. Because if you think about it, channels are just parallel trend lines. You know, just 2 lines, but they're parallel, right? So that's why it's called parallel channel. Right, so you need minimally 2 at the top and 2 at the bottom to identify a channel. I don't use channels to trade exclusively. They are part of the larger equation, right? It's the trend in the direction, you know, of your trade. In this example, right, you can see, firstly, we found resistance here, so there's a chance that price might reverse, and the channel is telling us that it's a bearish channel. Bearish channel means that there's bearish momentum. Now you can apply this in Forex, you can apply this in shares, you can apply this in anything that has a chart. Okay, there's bearish momentum. Okay, price happens to be close to the upper channel where reversals usually happen. You know, it's like you have a channel. Price tends to bounce at the top, it tends to react at the top, it tends to bounce at the bottom. That's what a channel does, right? It just oscillates between the 2 levels. So yeah, you know, it's close enough there. So we've got 2 reasons why it's gonna go down now. Look at the 3rd reason, right? Oh man, it's terrible. I can't really see it. There's this thing called Ichimoku cloud, right? It's a little bit hard to see, but I have an adaptation of the Ichimoku cloud, which you can do within the Momo app itself. You just remove everything else and you leave the cloud over there. It's a little bit hard to see, but there is actually a little bit of cloud over there, right? So the Ichimoku cloud, right? Why I remove everything else is because I want to keep it simple. It is just a good gauge for momentum. Alright? Ichimoku cloud, you need to think about it like the clouds in the sky. Right? Sometimes we go out, we know that it's gonna rain. Right? Sometimes we think that, hey, it's probably just a passing cloud. If you go out and it looks like, you know, end of the world, right? Skies are dark, right? You know it's gonna rain. You know there's a very high probability of there going to be a rain. And you know that when it's going to rain for hours. Sometimes you look in the sky, there's just 1 or 2 clouds there, you're like, hey, you know, it's safe to go to Sentosa kind of thing. Alright, so that's what the Ichimoku cloud is, right? It gives you a gauge on how big the clouds are above you, right? And you know how much bearish momentum, or if the clouds are below you, you know how much bullish momentum there is, right? This is a super simplified way I found that very effective in identifying momentum, without, you know, throwing out all the different moving averages out there, right? The Ichimoku cloud, whether it's above or below, right? And of course, if it's above, you kind of want it to be in a nice little, a little bit hard to see, but like you want it to be nicely above there. You don't want it to be down, up, down, up, down, up through the, you know, through the price. You want it to be like consistently above price, okay? the next thing, Fibonacci, okay? Within the app, the Momo app is called the golden ratio, or they call it golden ratio or something like that, right? Which is true, Fibonacci. In the world of trading, right, and speaking from all these years of experience, right, there are very few leading indicators. Now, when we trade, most of the time, we use lagging indicators. A moving average is a lagging indicator, right? Price needs to form before the moving average can occur, right? We always hear about the fallacy, the weak points of moving averages or trend trading is that by the time, if you're just trading moving average crossovers, for example, by the time, you get in the direction of one, but by the time it changes direction, you have to lose a lot of your profits already. That's a lagging indicator. The stochastic is a lagging indicator, right? The parabolic SAR, a lot of indicators are lagging. In the world of trading, I feel like there are only two leading indicators out there. One is volume and one is Fibonacci, right? Both are not that easy to apply. Both are not that easy to understand, right? But Fibonacci, if you know how to use it well, it actually tells you in advance where price might be reversing from, where price might be bouncing from. No other indicator actually tells you that. You think about it like the moving average. Only when the crossover happens, they say, okay, now, get in now, right? Change in momentum. It's usually one step late. The price will have moved a bit already, right? Fibonacci, there are four kinds of it, right? There's Fibonacci retracements, Fibonacci extensions, Fibonacci projections. Not easy to learn, okay? There's a lot of them, right? But if you know how to master them, you get to project in the future where price might reverse from, price might bounce from, okay? Now, Fibonacci over here. So the trick to Fibonacci, right? I'm just going to give you guys a few things that I notice a lot of people make mistakes on. When you draw Fibonacci, always ensure that when you're drawing the line, you can see this small little dotted line that goes all the way to the bottom. Ensure that it follows price as closely as possible, right? If there's one lesson I teach you that you don't find out there that often. Meaning, you notice that price tends to follow the Fibonacci quite closely. It doesn't go all the way down, all the way up, all the way down, all the way up, all the way down. It tends to follow price quite nicely. That's the important thing about Fibonacci. Okay, try to make sure that it goes as close to price as possible. Alright, so this over here, we have this thing called a 23.6% Fibonacci. Okay, there are many different Fibonacci you can use: 23, 38, 50, 61, 78, some even 88, right? 1 to 7, a lot of different levels. But I'm telling you that you will always find Fibonacci levels. So the trick is not in using a single Fibonacci level, but multiple confluence, right? Confluence of factors, which I'll be showing you in a bit. Okay, I'm going to pause for a while here and open the floor to questions, right? I believe Olivia has been staring at me right now, right? It's like stop a bit, right?
Yes.
Okay.
So Desmond, you covered many indicators and also use a lot of terms. We've got a question from the audience online. They want to know, do you use just one indicator or you use it with another, such as price, action, or Ichimoku together? Or do you use SMA 200 breakout?
Well, those are all, SMA is a simple moving average, right? The short answer to that is I use multiple indicators together, right? So in this example that I just covered, right, we did support and resistance, right, which was technically one indicator. Then we have a channel, which is technically another indicator. You think about it, what does the term indicator mean? It indicates whether price is going up or going down, right? It's your way of interpreting the market. So I have I got supply resistance and channel. Now I just added a third indicator, which is Fibonacci retracements. All right. So yeah, long answer to a short question. I use multiple indicators together. Okay.
Any questions from here, the audience in person, so far? No? The gentleman on the corner there?
Anyone, any questions so far?
Any questions? Okay, that's good.
Okay.
Okay, if I can, I'll ask another question because they're all coming from the audience online. So Desmond, in which context do I choose a lagging indicator or a leading indicator when I make a decision?
All right, it's a good question, right? The answer to that is you use both. Okay? Like the benefits of Fibonacci is good in forecasting where the reversal might happen. But the chances of that happens a lot less successfully if it is not in the direction of the trend. How do you tell the direction of the trend? Lagging indicators. Whereas the big moving average, the big 200 moving average, whereas the channel, right? Ichimoku is made up of different moving averages which are lagging, right? So it's actually the combination of them that gets the best out of a trade, right? So yes, both lagging and leading, you need to use them both to have like a balanced setup, right? You can't just be all lagging, always one step behind the market. You can't be all leading because you're not anchored to anything, right? So a combination of them is usually the best.
Could you summarize for us, this is a question for myself, in finding the confluence area?
Okay, in order to find the confluence area, I'm guessing you want to find a single point, a single area, so a good point there is area, where all the indicators are in agreement, right? You want to find it in agreement, meaning that in this example here, for example, sorry, it's not much of a summary now, right? In this example, if I was a 23% retracement, overlap resistance, but I had a channel that, price broke the descending channel. Suddenly that's telling me that, hey, price actually might be going up, right? So my indicators are not in agreement with each other. I got two of them say it's going down, but another guy over there says it's going up, right? And then I throw in a few more indicators, right? Maybe stochastic suddenly says actually, it might continue to go up. Then I have 2 versus 2, right? So they are confluence, but they're not in agreement. If they're not in agreement, it basically means it's like the stars are not aligned, right? Something is a little bit off, right? And that is where you would kind of stay out from the trade. So the answer to that confluence is that yes, they all basically need to meet at the parity and be in agreement with each other, right? They're like, okay, it's going down, going down, going down, going down. Okay, we're all in agreement, it's going down. Then is where you find confluence.
So far, we've covered the first 3. So we've covered establishing support and resistance zones. What is momentum? And now we've got the Fibonacci retracement. What is next, Desmond? Okay,
the next one is a little bit more technical, right? So it's basically Fibonacci confluence, right? So if I have a 23% retracement from here to here, it's a little bit hard to see, but I have a 61.8 retracement on a smaller time frame down here. So I got the longer term time frame, 23, and I got the shorter term time frame, 61, right? Don't worry about all these numbers. We will not know anything about all these numbers today, right? If anything, it should give you an idea of what you should maybe start researching on, right? But you notice that Fibonacci, you can do it across multiple time frames. That's the benefit of what we call a top-down approach, right? It's the same thing, imagine if I was, today, I was saying that, all right, Apple is going to the moon. Okay, I'm just looking at a 1 hour chart, the short term for the day, maybe Apple has been rising a bit. I'm like, Apple is going to the moon, it's going to do very well. But I didn't notice that, as it was going up, it was at a multi-year high, maybe for 10 years. Apple has never broke this level, right? But I was still saying that, on the short term, it looks like it's going up. So I'm very confident it's going bullish. But I didn't realize that if I were to take a step back and look at the longer term time frame, right, a top-down approach, I'll notice that, wow, you know what, maybe it might not break this level because, for 10 years it's never broken this level. That's the benefit of a top-down approach, right? A higher time frame to a lower time frame approach, right? So that's why in this case, we do a bigger time frame retracement and we do a shorter time frame retracement. They're both, so it's not only a confluence of Fibonacci, but it's a confluence of time frame. So I know that the long-term traders and the short-term traders are both looking at it. That's the gist of it, right? You want to find as many people who are in agreement that price is going to drop, right? A rule of thumb I have here, right? Because I know no one's going to ask questions on this, right? But a rule of thumb I have is that it's usually a multiple of 4, right? So if you're looking at the 1 hour chart to trade, you will go times 4 and look at the 4 hours for the higher time frame. You don't need to go into the 1 day or 1 week time frame charts. That's way too big, right? So you only want to jump 1 time frame higher. Usually that's enough to get a bigger view of what is happening in the markets. If you trade on the 15-minute charts, you times 4, right? It becomes 1 hour, Don't need to go too far away. The further you go, becomes less sensitive, less effective. A little bit more technical here, but yeah, so a higher time frame approach, easy way to do it. Whatever chart that you tend to trade on, just times 4. I mean, if it's the 4-hour chart, you times 4, the closest it is a 1-day chart, right? So that is more or less the rule of thumb to kind of use, okay? Now, so this part, I won't dive too deep into it, but we are basically finding multiple kind of Fibonacci levels to line up over there. So I think I have shown that there are now 6 reasons why price might drop. Now from my very first one that I drew, right, the support and resistance level, which is number 1, like I said, that might have given me a 30% chance of being right. But if I throw in the bigger Fibonacci, right, this might give another 10%, right? It's not a lot, but it's 10%. And I find another one here, right? This is the other Fibonacci, right? It's another 10%. I have the overlap here. So I not only have the channel, but I have the overlap, right? I have the Ichimoku cloud. I know it's a little bit hard to see, right? And I have the Fibonacci projection. It's a little bit hard to see also, right? But all 6 are lining up in there. Individually by themselves, they are not going to add up to much, right? One has 30% chance, one has 10, one has 15. It's not a lot. But when you add them together, that's where you're looking at confluence. Maybe you have 30 plus 10 plus 10, you know, plus 15 plus 10 plus 10. You go from 30% to maybe 60 or maybe 70%, right? I've done a lot of live trading sessions, right? That means the sessions are recorded on YouTube live, you know, for many financial institutions. We go on live, we analyze for them, right? We're doing it for more than 2 or 3 years. So there's no running away from the trades that, you know, the analysis that we did, right? And why we're doing it for so long is because we have a hit rate of about 70 to 80%, right? With decent 1:2 kind of risk reward, right? And the reason why I was able to achieve that is not because I know some magic formula, rather it's because I combine, you know, confluence. I give myself a higher probability of being right and wrong. I don't just analyze one chart, I analyze a few things, right? We've been in this industry for a long time, in the FX industry, analyzing, trading. I'm a young guy, I'm 33 years old, right? Doing this full time, right? And if anything I want to encourage you guys is that, you know, you don't need to be 30 years in Bloomberg, you know, to learn how to do this. You don't need a CFA, Masters in Wealth Management. I'm not sure if anyone here has that, but it's good if you had it, right? Okay, right? But yeah, you don't need that, right? Necessarily to be a good trader. You just need 30 days learning the right things. Okay, right? And yeah, if there's one direction I'll point you guys in, is that, yeah, you know, you need to combine probabilities, right? I'm not going to point to you and say this is a silver bullet, right? If you apply this indicator, it's going to work. If you apply this moving average, it's going to work. It's not, right? You want to combine multiple things that agree with each other, and when they all line up, in this case, right, what then happens is that if it lines up well, right, trade management perspective, you need to find a good entry. Okay, find a good entry. You need to find a good stop loss, right? So remember, I touched on this earlier, trade management. It's not only about finding a good entry. A lot of people get the entry and then they stop loss and take profit is an afterthought, right? They're like, okay, 50 pips stop loss, 50 pips take profit, right? When this happened, maybe I just put it here, put it there, and just enter a trade, right? But if there's anything I do want to let you guys know, your stop loss and take profit are as equally important as your entry, okay? Because one is your entry, one is your exit, right? And if you don't use caution when you place them, if you ever notice that price went close enough to your stop loss, it stopped you out and it goes, you know, in your favor, right? That's actually a thing to do with stop loss placement. It's not random. Our price goes to your take profit, you miss it just by that little bit. It's 90% to your take profit, you miss it and it goes down to your entry or to your stop loss, and you think, wow, that is terrible luck. But it's not true. That is take profit placement. There is a science to that. We can't cover it today, right? But if there's one thing I want to share is that put your stop loss slightly beyond a key level, put your take profit slightly before a key level, right? Before and beyond. That's one tip I can share with you guys. Maybe in the future dive in a little bit deeper on it, right? So in this example, right, we have a simple entry, stop loss, take profit. Why do I put my stop loss there? Equally important point, all right? Some people, they put their stop loss maybe all the way up to here. Some put it up to here. You must know what is the reason for your stop loss. When you place a trade on the Moomoo app, you enter a trade, there'll be an option for you to place a stop loss and take profit. I recommend that everyone use it. because you don't want to enter a trade without any stop loss. Why do you put a stop loss? The stop loss is basically you telling yourself, at this point, if price reaches this level, I am wrong. My plan A didn't work out, right? Remember, in trading, when you take a trade, my reason to take the trade was all the 6 reasons I showed you just now for price to drop all the way down. Okay? Think with me over here. If price, after all of that probability that I added up, if it didn't drop and it actually went up to here, right? It broke out the channel, went up a bit. I know I am wrong. Do I need to wait for price to come all the way to here to tell me I'm wrong? No, right? I'm wrong, and the sooner you can accept that you're wrong, the tighter you can keep you can put your stop loss. And I showed you just now, the tighter your stop loss, the better your take profit. There is a price you pay for being comfortable, right? There's a price you pay for having a very fast stop loss, and price will just break out and come all the way up to here and stuff, and you're like, oh, my stop loss is very far away. I feel very safe, right? I feel there's no anxiousness, to trading. But there's a price you pay for that, and that is the risk reward, right? There's a price you pay for the comfort of a wide stop loss. Okay, so don't just always go for a wide stop loss. Know where your stop loss is and why you're putting it there. So in this example, of course, we expect price to drop. I think what happened, right? Okay, in this example, right, it's one of many examples we send for live analysis, right? In this example, price dropped very nicely to our take profit. Okay, it's an example of confluence, high probability reversal. How you measure how successful your reversals are is if price is able to reverse right on the dot. Because the tighter like I said, tighter to your stop loss, your risk reward actually increases exponentially, right? So if you have a super tight stop loss, instead of the usual 1:2 kind of risk reward, you might get a 1:20 kind of risk reward, right? So it's how tight you can keep it. All right, so that's how you should train yourself. Don't just enter a trade and look at profitability. Enter the trade and see how well you call it move. If I say it was going up, did it really go up right away, or did it go down and go down and go up and go down, multiple times? The more accurate you can call a trade, the market will reward you for that, with a better risk reward. Okay? Yeah, so these are the few things, obviously this part here is a little bit more on, I'm going to show you guys how you can, it's more of an in-app demo, right? Where I'll be showing you guys how you can draw the Fibonacci, right? You can draw the channel, right? If you use the desktop app, it's a little bit hard to see, so I might skim through this, right? But yeah, you can click the top, you can click parallel channel, right? If you're on the mobile app, it's this thing down here, parallel lines. So they don't call it a channel, call it parallel line, right? Fibonacci, a lot of people couldn't find it. I couldn't find it myself earlier, right? It is called the golden section, right? Now it's golden section because of the golden ratio, and also because they made it gold in color apparently when you pick it, right? But that is Fibonacci, okay? If you ever need to find it, right? So you click, right? Golden section. You get to edit the Fibonacci here. One thing I would do, right? If you want, and also take a picture of it. I edited some of the values here. 1.272 instead of 1.236. Right, would be one of my key things that I'm editing, right? And 1.382, right? These are just some values to take note of, and goes in section here. Okay. Now the Ichimoku on the desktop, mobile, it looks kind of messy, but there's something you can do, right? Basically, you go there, you click on it, you click chart management, and you go to indicator management, and you can actually change the colors a bit, make things different colors. And if you play around with it a bit, what you might end up with is, well, if the contrast was better, you'll be able to see it. But basically, you get a nice little orange cloud instead, like in the examples I use, right? It's not going to be like this, or this makes the chart a bit messy. But if you can edit the indicators management, it becomes a lot neater, like this. Okay, let me see. Yeah, and for mobile, it's over there. Okay, but yeah, I came to the end of the section where I'm explaining how to use the different kind of elements. There's support and resistance, there's momentum. You can use channels, you can use Ichimoku, right? You can use a Fibonacci, retracements, extensions. I'm going to say a couple of indicators here which you can use a little bit more of, because I only show you a bit of it, right? You don't need to use all of this, right? But some of the other things I use the stochastic RSI. I especially look for divergence. Okay, bullish bearish divergence, very good at calling the reversals, right? For the larger momentum, I tend to use a little, I don't only use the Ichimoku, right? I do use a little bit of the Death Cross, Golden Cross, 50-200 moving averages, that crossover. I also use that as a bigger gauge of momentum. And of course, I use correlation. As magic, there's a lot of magic in correlation, which I don't have time to cover with you guys over here, but I do want to point you guys in that direction. Using correlation is like almost like having ChatGPT double check your work, you know? Because sometimes I'm thinking euro dollar is going up. If I think euro dollar is going up, if you know what's correlation, right, that means the market actually moves in tandem with each other, and it happens a lot. It's like, easy example, Bitcoin. If Bitcoin is going up, technically Ethereum in some direction would go up, right? That's positive correlation. So the danger, if I'm going to use crypto over here, right? If Bitcoin says it's going up, but I look at its friend Ethereum and it tells me it's going down, then I would say, whoa, something is not right here. Okay? Alright, something is not right. One is going up, one is going down. So I better be careful. I will allocate less risk to this trade. I'll probably be a little bit more careful. So that's the same thing with Forex. You know, there are many different kind of correlations. Euro dollar go up, dollar franc go down. Dollar franc go down, DXY will also go down. Right? I'm just showing a couple of correlations over here, but you want to read up on it. Right? Because when you do, it can help you avoid a lot of those false breakouts. Many times you take a trade, you think that it's going to go down, and then it wasn't a breakout, it wasn't that double top, it wasn't that head and shoulders, and price actually come back up, and like, darn it, if there's only a better way I can confirm my breakouts, it's correlation. It's tough, a little bit tough to use, right? Tough to understand, but if you know how to master it well, it can really help you filter out a lot of the setups. Okay? Now, alright, so what I'm going to do now is I kind of showed you guys a lot about the technical parts. I'm going to take a moment to show you in-app how to execute the trades, how to load some of the indicators to use a little bit better, right? But yeah, just give me a moment while I load up the app. And Olivia?
So Desmond, while you're setting up for that, I've already got a question for you. So on the last point that you actually made about your own personal indicators, right? Someone would like to know personally, how much would you risk per trade, Desmond?
Give me a second. Testing. All right. Actually, that's a very good question. How much should you risk on each trade? So, I always like to answer questions in a very long-winded way. Sorry. All right. So, a lot of people think trading is binary. You buy or you sell, right? No, you enter a trade or you don't enter into a trade. But that's very far from the truth. Okay. Trading is not binary. Trading is probability. For example, if we look at a trade and it wasn't as nice a setup, right? Maybe, you know, if it's just 50-50, I might risk 1% on that account, 1% on that trade. Give you another example. If you really saw a time traveler, right? Came back in time, says that Desmond, in the next 1 minute, euro dollar or Apple shares is going to drop all the way. Okay? And he says that I have proof that I come from the future, there's undeniable proof. Right, you're super confident of that. Are you going to risk the same 1% on the trade? No, right? You'll be like, I wonder what I can sell now, right? Just get more money, put into that trade. Because you're more confident. The key thing here is confidence. The higher your confidence level, the more you should allocate to the trade. Some trade setups are just not that nice, right? Not everything is as nice as the example I showed you. Sometimes the channel might break out a bit, sometimes the correlation is a little bit off, sometimes the support resistance is not really there. But maybe out of the 5 secrets, maybe 4 of them were lining up. So instead of allocating, like usually for me, I have a range 1 to 3%. The best kind of setups, I put 3%, right? The bare minimum, 1%, right? As it gets better, I kind of put 1.5, 2, 2.5, 3, right? Because it makes sense, right? You want to, bank on your winners, those that have the higher probability of getting right. And those that just meet the bare minimum requirement, maybe 3 out of 5 or 2 out of 5 of the requirements, they'll be like, all right, it meets a setup, I will take the trade, right? But I know that it's not the same kind of confidence I have as a high probability trade. So I usually risk 1 to 3%, right? But it also depends on how nice the setup looks.
Great, thank you. And thank you to those online for your questions. Now we've got our first question from here in person. This gentleman would like to ask you something.
Hey, what time frame do you use your indicators to trade in? And is it applicable to other time frames also based on the one?
Yes, good question, Noel. Alright, so I tend to use the H4 time frame, and minimally I go down to the H1 time frame. I tend to stay a little bit away from the lower time frames like the 1 minute and the 5 minute charts. The reason I do that is because I feel like it's a lot more fluctuation. So technical analysis, the basis of technical analysis is that you need to find more people in agreement with you, right? If like, for example, the examples I showed you, it is not only the people who believe in support and resistance. It was the people who believe in support and resistance who also believe, and the other people who believe from channels, the other people who use Fibonacci, the other people who use Ichimoku, all of them come into agreement with each other. Then they say, all right, price is going down. You need to find agreement, right? Now on the shorter time frame, firstly, there are less people trading. We can all agree with that, right? Because technically, if you're trading the 1 day time frame, you're also kind of trading the 4 hour time frame, right? But if you're trading the 1 day time frame, if you're trading the 1 day time frame, it's very rare that you go down to the 1 minute time frame. It moves a little bit too fast. Right, so the shorter term time frame, I've noticed that there's a lot more fluctuations, a lot more noise, and because when there is more noise, it's like trying to find a parking lot, right? If there's radio blasting in the background, it's just hard to find a way around. It's the same thing in trading. If there's too much noise, right, on the smaller term time frame, it's a little bit harder to take those trades. So I tend to focus on the 1 hour, 4 hours, and I use the 1 day as my overarching kind of view for the week.
Thank you for that question. Now we've got one question from this lady over here.
Yeah, I just want to ask you like just now the channels and Forex. Do you use trigger candle to get in? And also the strategy like this, is it a fixed trading pair or you subject to workout pair?
Okay. The first part of the question, you say that the channel, do I use what? Trigger candle. Okay, when you say trigger candle, do you mean that okay, alright. No, I don't. Alright, so the approach I usually use pending orders, meaning I get into the trade before that. Candle, the problem with using price action, I love price action, but it's more something which you, it's like in the thick of the action. There's lagging indicators, there's leading indicators, and price action. Price action is in the there and now, meaning that it happens. You do not know if an engulfing candle will happen until it happens, right? And when it happens, that's where you can maybe allocate more to the trade, you scale it a little bit more. But for the first entry, I always have a pending order. I get in before any candle, because technically, if I have 5 reasons why it's going to reverse, engulfing candle is just going to be the 6th, right? It can lead me to allocate a little bit more to it, or maybe adjust my stop loss, but it will not be the deciding factor like the trigger candle. And the other question I have is was it time frame?
Trading pair.
Oh, the trading currency pair. I tend to focus more on the majors, right, and a little bit of the crosses. The popular crosses, meaning that majors, for anyone who want to know, is the stuff like those that trade against the USD. The big ones like the Australian dollar, the Kiwi dollar, Japanese yen, Euro dollar, pound dollar, right? Crosses are when 2 popular currencies, right, but there's no USD. For example, Aussie yen, right? Euro yen, pound yen, right? All these big countries, but they're not against the USD. So those are crosses, right? So I tend to trade those. I tend to stay away from the exotics, right? So the dollar ZAR, right? The Philippine peso, right? A lot of the exotics, I stay away from them because fluctuates a lot crazier. It's hard to call a reversal when there's so much fluctuation, right? And I tend to stay away from the emerging, right? So I tend to focus more on the majors and the popular miners. Yeah, if there's a tighter spread, you know, like Mumu has pretty good spreads. I've checked it myself, right? You want to go for those, you know, majors and minors, really good spread. Usually can enter better. Your chances of you being correct in forecasting those reversals are slightly better.
Thank you, Desmond. Now we have more questions from the audience here, but I'm just going to hold that for a second. We would like to know what you have to share with us for the quick tutorial that you have prepared.
Oh yeah, quick tutorial, right? Question. So this is the Mumu app, alright? So I just want to share with you guys really quickly how to use it properly. Alright, so you can have the dark theme, you can have the light theme. Now, I'm going to stand it this way so that the ear piercing thing doesn't come out. Right? First things first, right? When you log into Mumu, right? When you log into Mumu, there's a whole bunch of things that you can trade over here, right? Forex is the one that you want to go to, right? I mean, they have crypto, they got futures, they got Forex, right? Popular ones, US and options, but Forex is the one that you want to go to. You will notice, right? You will notice there's a whole bunch of different instruments you can trade over here. The way Mumu has grouped them is slightly different from depending on broker to broker or where you find it, right? For example, Euro dollar appears in Europe and Americas. Asia Pacific, they show this over here, Aussie CNY, right? Tradable ones, I'm guessing they find it the most tradable, right? So let's look, for example, at Euro dollar, right? The most popular one. You click on it, okay? The chart over here, okay? To maximize the chart, you guys should be familiar with that. Is this button at the corner, right? You will. I noticed I was pointing at it, but I realized no one will be able to see I pointed. But it's at the corner. It's at the bottom right corner. Okay. Now these little things on the right, there you see that are lighting up. These are the on-chart indicators. Okay. The one that I use is IC. That's the Ichimoku Club. Okay. So yeah, you can toggle really by the side, and if you're into technical analysis, which hopefully after today's session, for example, for me, I combine a blend of fundamentals and technicals, right? Because fundamentals could technically be another, another reason why price might go down, for example. So if you already know fundamentals, that's great. Learn to take technicals, and when you start using technicals, especially on the Mumu app, you notice that these things by the side, right, very useful in throwing on and off indicators. I actually thought it's a very, very smart way that they did it, right? A lot of other mobile platforms, you need to click, you need to add, you need to go there. It's a little bit hard. They allow you to toggle between them really quickly, right? The top button, right? The top button here, over here, is the one above the versus. This is the part where you do have the drawings, right? So these are not automatic calculations that are done for you. This is the part where you can start drawing a bit. What we use today. The first one up here, right? This is the channel, right? Parallel lines, right? Click on it. You can click on anywhere. You draw it, click, and you move the other. Yeah, basically, you can move the other one down, right? You can move the channel up. You can move the different levels here and there. But the first one is the channel. Okay. If you want to find the magic Fibonacci, all right, the one that you have to click on is this one here. Retracement golden section. Oh, I didn't realize that the flip retracement was there. I'm pretty sure I just upgraded it or something. But yeah, so here it is. You pick your starting point, you pick your ending point, and you have Fibonacci retracement. The only thing that I want to share with you about this particular Fibonacci retracement is that different brokers do it differently, or different charting platforms do it differently, right? This one picks the starting and ending point. You notice that the first point, I picked the ending point up there, the first point is 61.8, so it's the opposite way around, right? Meaning that you need to pick the right side to the left, not left side to the right. Okay, it's a small difference, right? Depending on the charting platform. So this is what I noticed for the Mumu app. If you ever use it, you know how I used to draw from here to here, you start from here to here instead, right? Okay, but don't dive too deep into that, because if you, for example, in our analysis today, we look at it and we're like, okay, it looks like, let's go and delete everything here. If it looks like price is going to go up, maybe I just stand here instead. Yeah. Okay, if it looks like price is going to go up, correct? And we decide that we want to buy, right? The one that you want to click at is at the bottom corner of the screen, right? The open and close. You click on it, right? Then you can come here, okay? Open and close. Now, it's unlike some platforms that choose whether to buy and sell. So if you are choosing to open a trade, you just focus on open, okay? Now, the thing that you want to notice here, right, is this thing called order limit, order type. Pointing doesn't work, I realize. Right? Order type, right? So you have the limit, you have the market stop limit and stop. My way of trading, right, I don't wait for the trigger candle, meaning that I usually use the limit orders, right? The limit, the stop limits and the stops. All right. If you want to know a little bit more about it, they have this handy little thing called Learn More. It's really, really well done actually. Right? You can actually come in here and actually show you how the trade is triggered. Right? I needed to check it myself before this session, just double check. But yeah, it's a really, really good example, right? To show you the different kind of order types that you can use. Okay? And let's just say you want to buy. In this example, I'm going to buy a market. What does it mean to buy a market? It means that you're getting in right here, right now, at the current price, at the market price, right? That basically means what market means. So people say, if I look at a trade, I want to get in now. You're looking in at the market price. Lot size, you know, as you increase it, you can see the amount of margin that you're using, basically how big your lot is. Now, one bit of advice, if I can give you guys, is that you don't calculate the lot size yet. Right? Don't just randomly put a lot size. How do you know what lot size you're going to put? Alright, I'm showing you how to put the lot size here, but personally, usually what I do before I get into the trade is I know my entry, I know my stop loss. Okay, if I know my stop loss is, let's say, 30 pips away, 30 pips, right? Once I know my stop loss, the next thing I need to know is how much you want to risk on the trade. 1, 2, or 3%, for example. If I choose to risk 1% on the trade, right? So I will calculate, if I have like $1,000 in my account, 1% is like $10, right? I will reverse calculate so that if I were to get stopped out at 30 pips, right? I would only lose $10. And for that to happen, then you know what is the lot size you should trade. Okay? So I know it's a little bit more advanced here. I'm teaching you how to use the lot size, right? A lot size is basically like the number of shares that you're buying and stuff. But if you want to apply proper risk management, ensure that you know how much you're risking, how much you're going to lose first before you trade, and you can only know that once you know the stop loss, which is down here, right? TPSL at the bottom here. What's the take profit? What's the stop loss? I recommend minimally to always have a stop loss in place. Okay, and the last one, fill policy. Immediate kill is quite simple, right? If you don't manage to fill it, then you just cancel it. Okay, but yeah, so once it's done, you just click like buy to open. Trade is triggered, right? So I think it's under positions. There you go. So all the different trades, these are sample accounts that we have, right? So anytime you want to close the trade, you will notice that the TP and SL is in pips. But if you want to close the trade, you just click close. They'll ask you to select the position that you want to close, like the one the most profit, for example, and you can choose how much of the position you want to close. Then you close. Okay, but this one is the quantity is not right. I think it's only 0.01. Close. Okay. Yeah, more successful. That's a freedom to close. Alright, but yeah, so in this case it closed. Alright. I just close it off there. Oh, sorry.
Great stuff. Thank you so much, Desmond, for that. So we have one question from the audience member here. What's your question?
Hello. I just want a side question. Just what you were saying that about textbook and stuff. So let's say for Japanese candlesticks, right? So they have all these different candle combinations like Morningstar, Evening Star, or Harami. Like because I borrowed a book from library, so they have all this huge list of like combination patterns.
Yes.
So is it applicable to like? Do we really need to like remember everything, or just understand like the relationship in candlesticks, or just have to like apply everything? Like they have a lot of combinations like 10, 20 plus.
Oh, you're talking specifically about candlestick patterns.
Yeah, correct.
I would think usually when I apply candlestick patterns, right? You do need to knowing them is one thing, but knowing that it applies differently across different asset classes also matters. Meaning that for shares, seeing gaps is very common. when you see gaps, then you can see candlestick patterns like the morning star, abandoned baby, some very morbid names with the gap. But if you're trading Forex, you're less likely to see that because it's of the liquidity, right? And it's open 24 hours, 5 days a week, right? So it's that's one thing to take note of, right? Between the different asset classes, you're going to see different kind of patterns. So Forex has a different set of patterns compared to like shares. And the next thing to take note of, right? And this goes for anyone who uses price action, right? You need to consider two things, right? One is the lead up, okay? Meaning that if you see a bullish engulfing candle, right? For those of you guys who are not sure about it, bullish engulfing candle is like a very strong bullish candle. The previous candle is a very weak candle, right? You need to know two things. One, it usually works better because it is technically a reversal candle. Reversal patterns for price action, they work better at, when things are overbought. It works less effective, when things are rising and then you see a bullish engulfing is nothing. Bullish engulfing candles, when price is rising, you're going to see it everywhere. But I see it at the bottom, they'll be like, wow, this is a rare Pokemon, right? It happens there, it means that the sign is going to reverse. The next thing that you need to take note of, right, is context. If you see a bullish engulfing candle, right, don't always follow things too technically, okay? So the technical term of a bullish engulfing candle, one big candle, one smaller candle, okay? What if, right, you think about it, right, wrestling, or maybe soccer, right? If Manchester United were to beat Manchester City or Liverpool, right, big match, you'd be like, wow, okay, this is a big result. If Manchester United were to beat Plymouth Argyle, right, in some second division, people will be like, oh, what is that, right? And it's not indicative of anything, it's expected. So if you have a big engulfing candle, but your previous candle is a tiny candle, right, technically it's correct. It engulfs the previous candle, but that candle is a tiny candle. It doesn't mean much, right? So this is one of the things that a lot of these books, they don't tend to focus on, is they focus on the technical definition that yes, engulfing candle, open and close is technically supposed to be higher than the previous candle, but you also need to apply additional kind of logic to it, right? Is it a big battle between the top two teams, right? And of course you want to see big battles. Technically, if both candles are big, but it's like, two bottom tier clubs, right? Everton. Okay, any Everton? Sorry, no offense. Very dangerous. Any two teams which are at the bottom of the league, right? They find it out, they win. People are like, oh yeah, but we're more interested in that, right? So you're looking at, you must see the context also of engulfing, but how big is it, right? What is the market size that leads up to it? And the key to that, I'm not going to throw another indicator, is ATR, average true range, right? So average true range measures the range of market. So the range of euro dollar is very different from the range of pound dollar. The movement that you see in Tesla is very different from the movement you see in Johnson & Johnson, right? So things that can adapt your indicator, your readings to the market is actually ATR, average true range, because it takes the range of market. Then you know whether your bullish engulfing candle is supposed to be 1 times ATR, not 0.1 ATR, because anything can mislead you, right? You need to adapt it to the different asset classes, you need to adapt it to the different kind of size. Okay, sorry, I digress a bit.
Thank you so much.
Okay, no problem.
Thank you so much. I think that's a great way to end off our live Q&A with the audience. Now, I've taken some notes myself, and to summarize, here are some key points. You mentioned to accept that you're wrong as soon as possible. There's a price to pay for being too comfortable. Be intentional and know why you're doing something based on calculations, and consider using divergence in reversals or multiple indicators at the same time. Now, final takeaway in one line for our audience watching.
Oh, one line. No punctuation and go all the way to the final takeaway is that, in trading, especially Forex, it's not that different from shares and stocks. In fact, if you know how to pit, it's just not you versus a company anymore. It's like you're pitting two companies against each other. Strong versus weak, strong USD versus weak AUD. If you know how to do it right, actually can give you, personally, myself in the trading space for so long, you can give yourself a pretty good edge in the market, right? There are a lot of, right? There are a lot of studies out there, right? There are a lot of gurus out there, there's a lot of things you can pay money for. My personal take is that you don't need to pay for those, right? I went through Mumu's own education course, really comprehensive, right? But a lot of it is that the key thing I told you today is a combination of factors, right? If you learn from a person who's a master of moving average, you only know one thing. You only know what the people who use moving average think about. Widen your perspective, right? By looking at the different kind of indicators out there, the different kind of studies, right? I even go as deep as Elliott wave, harmonics, right? If you want to go into crazy stuff, there's a Hurst cycles which measures the timing of the market. You combine them all together, right? You can get a higher probability setup. But remember, if you combine too many things, you might end up not trading at all because none of them will always agree with each other. All right, so it's all about, like we started at the start of the session, right? Probability. It's never definite, but you want to increase the probability of trades as much as possible to be in your favor. Yeah.
Excellent points, Desmond. Round of applause for Desmond Leong, founder and CEO. Thank you so much, Desmond, for joining us today. Now, with the time we have left, we've got Brandon and Samson at the back. If you have any more questions regarding Forex on the Moomoo app, as well as Desmond himself and his brother at the back to answer any questions if you have any for them. And use this time, the time we have left in here, to network and get to know us, because this is the start of connecting as a community. Now, until next time, I'm your host, Olivia Higgins. We'll see you soon. Have a good evening.
Thank you. There's a few styles approaches to like volume analysis, right? The very best